So hello, everyone. We're recording. Again, my name is Kayla Farking. I personally am a division manager for asset preservation. We are a national 1031 exchange accommodator. So API has been in the industry for 31 years. We've done over 250,000 1031 exchanges. Lots of capability with our company. We have a headquarters in Northern California and also an Eastern regional office on the East Coast. So as mentioned earlier, prior to recording, I see more people coming in now. I'm going through pitfalls to avoid in a 1031 exchange. I've been in the industry for over a decade and doing 1031 exchanges. When I had the realtor hat on, I was always focused on the overall meat of what it means to do a 1031. I think there's a few crucial takeaways that are important, and really your job as a quarterback or the realtor in the transaction is to delegate to your O-line, right, to your team. So we are in NFL season. I will be using terms. I do have to note, sad thing yesterday for the Padres. I am a Padres fan from San Diego. So those of you that are Dodgers, we're in it together now, or I should say out of it. Moving on, I want to just start with a couple things of disclaimers. Let me make sure this is working. Give me 1 second here, a little technical difficulties on Zoom. Making sure my pointer is active. Okay, we're gonna go old school and click through. So thank you for your patience. One more time. Okay. Now, we do not give legal tax advice. So I just really want this to be the first major takeaway. Anytime that you have an exchange client, a taxpayer that's asking you for that legal tax advice and you refer an accommodator and they're asking me specifically what their gain or their taxable event will be, we will direct them to their CPA. Once we get into the weeds with their specific income, their bracket, that's legal tax advice. That's good takeaway as well for you listening in for realtors and industry affiliates. Now, in the recent 1031 exchange trends, we've been seeing a lot of after COVID, right? The exchanging out of downtown areas into suburbs, people wanting more land, and believe it or not, on the flip too, people who are living out in the suburbs wanting to come back in and be where the action is, buying investment property in the metropolitan areas. So we have a big uptick for property in rural areas or vacation destinations, as mentioned, and working from home, right? I think a lot of us right now are I'm currently in my home office. So I kind of have a hybrid role right now where I'm sometimes from home and sometimes out in the field. And I really hope that some of you I get to meet face to face next year when we're doing this class in person. So yay to that. Now, when we see here on this bottom bullet point, the states that I'm personally seeing when we have clients that exchange their investment property out of California, where are they going, right? So we're seeing Texas, Florida, Tennessee, and Wyoming. Those are my 4 big states and the direction of where our clients are going specifically. Now, I'm stuck here, there we go. So the political, climate, and tax issues, this is something I wanted to briefly touch on. A lot of you are calling me with the questions on the fiscal year 2023 budget for Biden's family tax plan again, right? So we're seeing this proposal of a cap. This happened last year as well, for those of you that remember, but in a brief overview, so you can understand what that cap means. I'm going to give you an example. Let's say you start with a property that you purchased for $500,000. That property you decide to sell, call it a decade later, for $1.25 million. So $1,250,000. When you go to sell that investment property, this statement here says that they're going to cap your gain taxable deferral on 500 gain. So that would leave me with my example. 1, I bought for 500. 2, I know I have $750,000 in gain because I'm selling for $1.25 million, right? So in that example, what would happen is you could only tax defer the first $1 million, which was your basis or your original purchase price of 500 plus your gain of 500. That leaves this surplus of 250K, right? So that 250,000 is actually going to still be taxable. So that's what that proposal means. They're trying to pull more taxes out of that taxable gain and still allow some deferral. Last year, this was tried to be pushed into the budget and the Biden's family tax plan. It did not happen. So we still do not expect that to happen. Fingers crossed it doesn't. Majority of our properties out here in Southern California, there's a lot more gain than 500. So moving on, I'm going to discuss a lot of terminology today. So as far as the terminology, I'm going to give you a brief overview of the terms. And as we go through, you'll start hearing me bring these up in the transaction structure and the pitfalls of what to avoid. I know there's going to be plenty of questions. We all have them, and I'm sure your questions are incredible. So I want to get to each and every one of them. What we're going to do is pause after every pitfall, and I'll give a little window here if you want to type your question in either, probably the chat might be best, or the Q&A, whatever your preference is. I'll look at both of those at the bottom of my screen to make sure they're answered, and then we'll move into the next pitfall. Okay, now again, there's 9 of them, so bear with me. I hope I have your attention, and please, again, don't be shy, ask the questions. That's what I'm here for. First and foremost, we have actual receipt of funds. So actual receipt is exactly what it sounds like, right? You're actually touching sale proceeds. So you're collecting it and there's a taxable event. Anytime you receive a paycheck, it's taxable, right? So think of this as capital gains. You sell a property in a traditional sale and you collect money. That's actual receipt. Boot, there's cash boot and mortgage boot. This is in alphabetical order for those of you who maybe thought mortgage boot was out on the right here. Both terms of boot is anything that is excluded from real estate. When you do a 1031 exchange, it's specific to real property. So if we did an exchange in my example of doing that cap of a 1.25 million and there's a surplus of 250K that maybe can't be exchanged or wasn't fulfilled on the replacement, that 250K is boot and is taxable, okay? Now there's also constructive receipt. Constructive receipt of funds is if maybe you have a client that decides they would like to do a 1031 exchange. It's a little last minute, and maybe you couldn't get an exchange set up prior to close. The money's sitting in escrow, they haven't touched it, they're still facing a taxable event. So we call that constructive receipt. They may have not touched it, but they don't have a destination or an assignment of a qualified intermediary placed into that escrow transaction. Now, direct deeding is us taking our assignment, which is a document, and stating asset preservation is the new seller on a property to be exchanged. Then we also become the assisted buyer when they find replacement property. So we're direct deeding title back to the taxpayer as the middleman loophole in the transaction. Okay, and I'll get into that, what it looks like visually as we get through the transaction and the proper function of where the money goes. The exchanger, investor, and taxpayer, all the same person to me. They're your client doing a 1031 exchange on investment property. Our exchange agreement must be prepared prior to close of escrow on the property they're selling or relinquishing. The exchange period is a total of 180 days, and those are calendar days. The identification period is inclusive of the exchange period. It begins the exchange timeline of 45 calendar days to identify, then an additional 135 days to close, giving you that total exchange period of 180 calendar days. Now, like-kind property is anything held for productive use in a trade business or for investment purposes that is solely real estate or real property. We briefed on mortgage boot. I'm going to give you a visual of that as we go on to help in that understanding component. And specifically a qualified intermediary, that is asset preservation, the company I work for. So we're also known as an accommodator, a facilitator. What we do is prepare that exchange agreement and assignment and hold sale proceeds in between the sale of investment property and purchase of more investment property. The relinquished property is the property being sold, also formerly known as the down leg, and the replacement property is the property being purchased, right? Or the up leg, formerly known as. So 1031 exchanges have been around since 1921, right? So that's a lot of 1031 exchanges. You're over a century of exchanges. So when you meet with a client and they get weary about this tax code, please recall this date, 1921, right? So a lot of 1031 exchanges done over the last 101 years, and I expect there to be a lot more. Now, this does, again, allow taxpayers holding real property for investment or business purposes to potentially defer all taxes that would otherwise be incurred upon an otherwise taxable sale of investment property. Another way to say this, breaking it down, what is a 1031 exchange? When you have a taxable sale, think of it as just a traditional sale. You put your sign in the ground, you list your client's property, a buyer comes in, let's hope you double in that deal, right? You open escrow, the transaction is complete, the seller sells real estate and they collect money, right? That's your actual receipt of funds. In a 1031 exchange, the same process happens. Your sign goes in the ground, a buyer comes in, the sale proceeds, however, go to a segregated account by the accommodator, held by the accommodator, and then wired over to that replacement property. So essentially what's happening there, they're not touching the money. They're having real estate in exchange for more real estate, never touching the sale proceeds. Now, this is direct from the tax code. I mentioned it before, it's kind of engraved in my brain. Just the big takeaway, these are 3 different examples of how you can explain the 1031 exchange and what it means for your client and what they can invest in, okay? So no gain or loss shall be recognized on the exchange of real property held for productive use in a trade business or for investment, if such real property is exchanged solely for real property of like kind, keyword there, which is to be held either for productive use in a trade business or for investment. So rather wordy, right? Think real property for real property, investment. What is excluded, right? So when we're talking about excluded, we know that it's investment property and it's real property. Now, you cannot exchange into a stock, a bond, notes, a REIT is excluded, beneficial interest for a specific piece of paper, again, REITs. So when you're looking at a specific real estate transaction in a 1031, in 2018, we had a shift from real property and personal property to specifically real property. That benefits everyone here at OCAR, right? When we're looking at that, it's specific to us. We've eliminated, or they eliminated, the option to be able to exchange, call it a jet for an investment condo, a condo for gold, diamonds for gold. Talk about sales in sports. Taking a contract held for investment, that contract or player appreciates, you can exchange them across the board. Fortunately, now we're focusing more on real estate. And again, I say unfortunately, because I feel like, again, sad news with the Padres, we're still in football season. But as we move forward, think of those cool, fun talking points, right? When you interact with a client, that we're focused more on the real estate and it's a benefit to them. So it's the last and greatest tool available in the tax code to help real estate investors. Now, our capital gain taxation, this is a big one. A lot of realtors in your seats ask me this question, well, what will I be paying on investment property, or my client be paying on investment property selling out of California? On average, they will be selling, or excuse me, having taxable gain out of California in the amount of 35 to 40% minimum. What are those components included, right? How do we get to 40%? Well, we have depreciation recapture tax at 25%. Over the years, if that client has depreciated their investment property, well, call it 100 grand. Uncle Sam wants the depreciation recapture at 25. So call that 25,000 out of that 100 grand they've depreciated. The federal capital gain taxes could either be 20 or 15%. Again, this would solely depend on the client's income or their tax bracket. That would be a great CPA question. Okay. Whoops, going back here. Now, next we have our 3.8% net investment income tax, or NIT, right? So this is healthcare tax, Obamacare tax. This was created a long time ago. It's been around, I think, since 2008. Now, the applicable state tax rate for California is the high end of the spectrum at 13.3%. So when we're taking those numbers, adding a few % depreciation recapture, you're looking again 35 to 40% in capital gain taxation on your client's gain. Last point takeaway before we get into the pitfalls for those of you who are not super invested and knowledgeable in the 1031 space, this is why we're here, right? So here's a visualization of what happens in the 1031 exchange sale or the transaction. You start out with the taxpayer, right? Our exchanger. They decide to list with you, and then you decide to become a double or dual agent representation. You find them a buyer. I love using that term because they were my favorite transactions when I wore my realtor hat years ago. You open escrow. You call Kayla Farking and asset preservation, and we go ahead and prepare our exchange agreement. Through a direct deed and the assignment, we now become the seller. So asset preservation becomes the seller through an assignment and the receiver of the sale proceeds at close. So now the sale proceeds went from escrow to that segregated account we hold on behalf of the exchanger taxpayer. We hold those sale proceeds within certain regulations and restrictions of the tax code. You help them find replacement property. Once they open escrow on the replacement property, we wire those sale proceeds over to the new escrow and then direct deed title back to the taxpayer or family trust or LLC, whoever was on title and is doing the tax deferred exchange. So when you look at this on your screen here, we're seeing essentially, it's an oval, but it's really a circle, right? The circle life of a 1031 exchange. Now we're at the bottom of this circle. Again, all our job is in this transaction is preparing an assignment, a segregated account that's insured and bonded, which we have every single transaction available for our clients. They are never commingled. We prepare those items and then we prepare that assignment so that those sale proceeds have a destination. So we're the bank, right? In between the sale and the purchase. It's that simple as far as the transaction goes. Now into the weeds a little bit about those ID rules. We talked about that 45-day identification period. That leaves the client with 3 options. Number one, they can use the 3 property rule within the 45 days for their identification terms, meaning they write down on our form property 1, 2, and 3. They can be any fair market value, but their limit is 3 max. That does not mean they have to close on all 3. They can diversify between 1, 2, 3. They can decide that maybe property 1 is the one they want and they have a backup plan, B and C, okay? The 200% rule flip-flops the 3 property rule. There's no ceiling on however many properties you would like to ID, call it 100 if you want. However, the 200% states those 100 properties that were ID'd cannot exceed a sum of 200% of what they've sold for. So let's say you sell for $1 million, you identify 5 properties. Those 5 properties, their sum cannot exceed 2 million, right? So 200% of $1 million is 2 million. The 200% rule is for an investor that does want to diversify, most likely beyond 3 properties. If you do have the client that maybe wants to sell 1, buy 1 or 2, let's stick in the 3 property rule. That's the most simplified rule and the one that's used most often. Now, again, I'm available to speak with your clients, jump on conference calls and explain this to you and act as your go-to accommodator should you need my expertise at any point in your transaction. Now, last but not least, the 95% rule combines both. They can identify as many properties as they would like. They can add as much cash and debt to exceed 200% of the sales price. However, they have to close on 95% of what they've ID'd. If one property falls out, they have a blown exchange. So there's really 3 different tools here for each type of investor, right? And I had a chat here. Okay, let's answer a couple questions on a pause before we get into the pitfalls. Ryan, yes, the slides will be the deck I can email, and then I'm not sure, Elsie, if we can or cannot forward those slides, but we can work on that. If you do need them directly, Ryan, you can reach out to me. Okay, and I'll email them to you. So now I have another question here before moving on. Do we have to use an intermediary, or can escrow alone handle the 1031 exchange? Great question. You do have to use a qualified intermediary. So a qualified intermediary means a non-disqualified, essentially qualified agent to the taxpayer within the 2 last tax-paying years, right? So they cannot identify to you. You cannot hold their funds as a sales agent. Escrow cannot hold their funds unless they have a separate qualified intermediary branch. Be careful with who you use. Be careful with where the money's going, because that's a reflection of your business, right? In attorney states, I work with a lot of investors out of Delaware, New York, gosh, huge ones right now I'm having in, I believe it's North Carolina is a big one that they have heavy attorney states, and there's so many different loopholes there. So sometimes attorneys there will act as a qualified intermediary, again, as long as they're not representing that person within the last 2 years. So on a larger scale, we have the capability as a QI to be that in and out transaction where, you know, an oiled machine for the last 31 years of business to help on that side. Paul's question, please repeat the 3 property rule. The 3 property rule. Okay, so within the ID period, day of close of the relinquished property begins that 45-day timeline, right? So within 45 days, you have to hunt and find replacement property. This rule states the client can write down 3 different addresses or APNs, assessor's parcel number, whatever one is unambiguously describing the property. So 123 Main Street, 456 Pennsylvania, 789 New York, right? Whatever the address is, that's what they ID. There's no ceiling on the amount or the total of those added together. So let's say, for example, your client is selling for $1 million. And they want to buy something in about the same range. They don't want to pay capital gains taxes. So for full tax deferral, they have to reinvest the net exchange proceeds or the cash and acquire a property with the same or greater debt. So they sell for $1 million, and each property they ID'd is maybe valued around $1 million. So let's say each are $1 million. The sum of those would be $3 million, right? So that exceeds the 200% rule, which 200% of 1 million is 2 million. So I hope that was a little bit clearer for you, Paul. If not, let me know. I can explain it one other way. So I have here, thank you. Thank you. Okay, can they sell 1 property worth 10 million and then purchase 10 properties? Absolutely, they can. So can they sell 1 property worth 10 million and then purchase 10 properties worth $1 million each? Yep. So if you're doing that, which rule would we use? Does anyone know? So specifically for me, I would use the 200% rule. Yep, Paul, that's correct. You got it. Okay, so they can absolutely do that. So just remember that if they breached 3 properties, which in your question they did, the 200% rule would most likely fit their needs, unless they're going way high and adding a ton of cash and a ton of debt to buy a specific portfolio of properties. Now, Ryan asked, it doesn't include closing costs on the sold and purchased properties. Correct. So if you're doing an exchange, and let's say you're selling for $1 million, we would take the $1 million and we would subtract closing costs. That's our number, our net plus our debt. So the net equity comes after closing costs, right? The cash due to seller would actually go to the qualified intermediary. The debt, if there is any, would be paid off, right, through escrow. Just because it's paid off doesn't eliminate it, however. The client has to find a property with the same or greater debt. The only way to not replace debt, right? So they have to talk to a lender. Maybe they had 200 grand when they sold their investment property in a mortgage, right? That was paid off. They need to acquire a property now that has 200 grand debt, or they can offset that need of a loan and bring in their own personal 200 grand. It's the only way that you can get around that. Now, Paul said, so they can identify up to 20 million in properties. Yep, using the 200% rule with your example where you sell for 10 million. So 200% of 10 million, you got it. Let's see if I can move forward here. So unambiguously describe the property. We went through these in the questions, which is fantastic. So thank you for the questions. We need to receive that identification form by the 45th day at midnight. Once we've received that form and they've breached day 45, so now you're in the morning of day 46, they cannot change the property or properties they've identified. So they have that additional 135 days to actually close on only the properties they've ID'd. What happens if they cannot ID? They don't find anything. If we don't receive an identification form by the 45th day at midnight, the proceeds we're holding are wired back to the exchange or taxpayer and they're facing a taxable event, right? So I highly recommend looking ahead at the properties and what they want to invest in. So pitfall number one, closing the sale of relinquished property without setting up a 1031 exchange. I briefly covered this, right? So when we're looking at this now, when you attempt to initiate a 1031 exchange at the last minute, right? What happens? Well, if you call me on a Friday before noon, I can typically get that set up for you last day. We have those capabilities being the company with the expertise we have. So make sure you call escrow, call me, stop the transaction, right? Pause, let us get that exchange agreement in place, which we can do again rather urgently. And keep in mind, our exchange agreement encompasses that assignment. The buyer has to sign off on that on the closing table. So it's good to mention this at the beginning of your transaction to save you paperwork and frustration on either end of the buyer and seller and not disrupt the transaction flow. So I do get these calls a lot. Hey, I had a client that closed on Friday. We want to set up a 1031 and it's Monday morning. It hurts me. It hurts my soul, honestly, thinking about how much money some people are spending in capital gains taxes, right? That 35 to 40% minimum. So even if there is just a consultation, which we don't charge anything for, call me, have your client call me. We can talk about it and see if it even makes sense for them, okay? It's an opportunity to find replacement property. Now I'm going to pause on that one. Are there any questions on the pitfall number one? Let me go to the screen here. I think I have one here in this Q&A. Okay. WRT, the identification. What are the identifiers? Document that needs to be filled out. Okay, so I think I covered that one. I hope that you saw that. There's anonymous attendee for the question. Now the chat. Okay, so do the properties have to be sent to an intermediary by the 45th day to be a valid 1031? So technically, day of close begins that timeline, right? We need to have that identification form if they do intend to use the 1031 exchange. If they've decided on day 30, even they're just done, they don't want to look for replacement property, the money we have or we're holding is returned on day 46. So it's an interesting question to be valid. To be a successful 1031, sure, absolutely, we need that identification form. You can't come up with the form after you've breached day 45. And we do need to be the receiver of that form. Now, historically, I've even received a text on day 45 on a napkin with a martini next to it, believe it or not, with properties, a signed signature, a phone next to it showing the date and the time. And I forwarded that to our CEO. That did suffice. Just keep in mind, we need to receive that rather sooner than later. We are not an accommodating accommodator, funny terms in the trade here, but we do not ever backdate documents. So that is illegal. It's better to just be ahead of the game with your clients. I have one more in the Q&A. Oh, no, that's good. Okay, so I'm going to move on if there's no questions on the first pitfall. Now, this is the cooperation clause that goes hand in hand with the pitfall one. I'm sure you've seen it. It used to be a necessity for realtors to include this. You may have seen it in the MLS. Really, it's, buyer to cooperate in seller's 1031 exchange at no cost to buyer, on the flip, the seller, right? So just make sure that this is somewhere. I know you have your SIE now, so you have that form through Zip Forms that you can use. That works. Really, what it comes down to is making sure that you have a fantastic qualified intermediary that has that assignment and the exchange agreement prepared in a timely manner. That is the most crucial document to have prior to close. Now the time requirements we covered, so I'm going to move past this one and get into pitfall number 2. So this is a neat one I wanted to add today, this plus partial exchanges at the end. So we talked about requirements for full tax deferral, right? So number 1, reinvest all of the net exchange proceeds, and 2, have the same or greater amount of debt on replacement property than what you had at the time of sale. So again, if you originally had a loan of $750,000, excuse me, on a property that you bought for $1 million, right? So you put $250K down essentially. When you're going to exchange, if there's only, call it $500K left on that property, which means it's 50% leveraged, if it still values at $1 million, you now have to replace the 500, not the original 750. Okay, so that's a good bullet point takeaway. Now, cash can be added to offset potential mortgage boot. We discussed that briefly. If maybe I have clients right now that have 100 grand, 50 grand, 200 grand left on a property, and they decide, well, I'm just going to bring in my own cash. I don't want to acquire a new loan with the rates. Fine, that's completely acceptable. Or last bullet point, a partial 1031. This lands you the opportunity to put your sign in the ground, land the listing appointment in the sale, right? That's the goal here. The market is shifting, so we want these opportunities with investors. You can pitch to them, well, hey, you're selling for 10 million, right? In that last example, if you're selling for $10 million and they want some liquidity, they can buy a property, call it for 8 million, or properties for 8 million in this example. That leaves taxable boot of 2 million, right? Let's say there's no closing costs in this example. So they have 2 million boot left over. Only the 2 million is taxable. Let's say it's cash. They're only getting taxed on that 2 million. They pay their own taxes when they file. The rest goes in their pocket. So they can do a partial exchange, let their money go to work from them by redeploying a partial or a portion of their investment into real estate while collecting some liquidity. It's kind of a healthy way to use both, right? Now, briefly on an equation for visuals, here's another one. These are good for takeaway visually. I'm a numbers person. Some people aren't. That's okay. This is why this is up here for you. When you receive the settlement statement, it's good to know your client's buying power. Well, what do I need to buy for full tax deferral? Okay, and what's going to be a surplus or boot? We know you have to reinvest all the net exchange proceeds and acquire property with the same or greater debt. This person sold for $900,000. They have a mortgage of $300,000, and they have cost of sale, which is closing costs, of $60,000. So we started with this big, beautiful number of 900, and what remains after debt is paid, broker fees are paid, recording title, escrow, closing costs, right? 60,000. Net equity of 540 cash remains. So that 540,000 would go into a segregated account that we hold on their behalf. They find replacement property for 1.2 million with your help. This means they're going up in value, right? From the 900. They talk to their rockstar lender and they say, hey, I'm going to acquire a loan in the amount of 660 to get to this 1.2 million purchase price, where my accommodator is holding my sale proceeds of 540. This means there's zero boot because 1, they reinvested the net exchange proceeds, and 2, acquired property with the same or greater debt, right? This screen, when you're looking at it, I put everything out here so you can get the off the bat, the visual that there is boot. Same sale. This person decided to buy a property for 700,000. Sometimes we look at the 900 minus 700 and think, okay, that's 200 grand they're paying. In actuality, they're paying 140,000. So they have 140 in boot, of which 35 to 40% is being paid out of their pocket, capital gains taxes. How did we get here? Well, on your screen, you'll see the transfer of the debt started out and was paid off of that 300, cost of sale reduced, right? So they decided, I'm going to acquire a loan in the amount of 260, thereby removing 40 grand of the replacement debt, right? Even though it's thin air, it doesn't exist, they still didn't replace it in the amount of 40,000 in the loan. And then they say, Kayla, let me know, I want to take some boot out at the close of the replacement of 100 grand, whatever remains in that exchange account. Absolutely. Here's the 100 grand, Mr. Taxpayer. Now, when you add the mortgage boot plus the cash boot, you have a total of $140,000 in boot, right? So they're only paying taxes on the $140,000. I'm going to pause there before I get into this next one and look at these questions. Okay. If there is a fee, is there a fee if the 1031 is withdrawn? First example, if a listing client wants to do 1031 right before COE, they choose not to go forward with 1031. Is there a fee? So let's say that we're not holding the sale proceeds yet. So they haven't closed even an hour before the timeline cutoff, and the burdens and benefits have been recorded to the new buyer. They can absolutely cancel their 1031. Second example, if a client wants to do a 1031 before close of escrow, it fails to find replacement property and chooses not to go forward, is there a fee? No. So we only collect our fee once they've actually closed on the relinquished property, right? When they close, they have a recording. The assigned seller with that assigned document is now asset preservation, right? So we hold the sale proceeds at that point, and that's when our fee is collected. Now, how about if someone only wants to reinvest half of the capital gains? How does that work? So in the partial exchange, when you're looking at a partial exchange, they can use any formula they want. If they want to take their basis, which always transfers first. That term basis, your cost basis, is your original purchase price. Call it 500. They're selling for $1 million. That means 500 was the original purchase or cost basis, gain of 500. And they want to buy a property for 750K. And that last equation example, we showed boot, right? So in my verbiage example, that would be 250K less closing costs that they'll pay taxable event on only the 250K gain. How old can a debt needs to be in order to not be included in the net equity? I'm not sure on this question. I'm a little confused. How old can debt needs to be? So maybe the question here, Jose, on this one is, can they pay off their loan before they close escrow? Sometimes there's red flags that are raised if someone pays off a huge chunk, because part of the tax code is to do the tax deferral and replace the debt and the cash, right? A lot of recommendations for our clients that maybe don't have debt, it's all cash, that they want to do a cash out after they close on the replacement. That is acceptable. Typically, our CPAs will recommend holding for a longer period of time. I would consult with their legal tax advisor on what that timeline looks like. Now, chat's here. Have you ever seen a time when the person who sold the old property failed to qualify for a new mortgage on the replacement property? I have not, believe it or not. I haven't seen that, but it's very interesting that you bring this question up, Ryan. I actually had a client that asked me that. Well, what if I can't qualify? And this was actually up in Laguna Beach when I was there teaching a workshop in person last week. My client is worried that they may not qualify for the replacement. I would get ahead of the game and talk to their lender beforehand. Again, be proactive in the transaction, know what to expect for your clients, and make sure that they have all of their team in line, right? Again, they can offset their debt with outside cash, maybe a family loan, right? Is there a way to do that? Sure, there's ways to get cash, hard money loans. It's really up to them on how to fulfill that need component. Let me go ahead and delete these. And then we're going to move into the next pitfall. If no one else has questions, okay. Pitfall number 3, selling or exchanging into a property that is not held for investment using a trade or business. Okay, so we briefly talked about what was included. We talked about what was excluded. So here's a visual of like-kind property, everything on your screen. I understand that this hype and this frothy market that we saw, right, when we were going from a day close way over asking price, where do we find replacement property? They're not even available. Why would I ID? So some takeaways on that statement. The client, if they close on the replacement within 45 days, there's no need to use an identification form. Closing on replacement is the purest form of identifying. Like kind. You can take their residential rental property, right? partner with a commercial broker. I just had this happen. One of my realtors in San Diego was asking me, hey, do you know any commercial brokers in Tennessee? I do. So their client was looking for a triple net lease franchise property, right? They wanted to buy something and then lease it out to an Arby's, right? So I aligned them with someone in that manner. I think it would be great to partner with commercial brokers, especially right now. If your client wants to sell single family and go into commercial, if they want to sell land, oil rights, mineral rights, vacation rental properties, right? VRBO, Airbnb, strip malls, tenants in common is a big one. Maybe there's 4 or 5 people that want to sell and they want to buy one larger investment property. Absolutely. Take your fraction and go in as a tenants in common on the purchase property. A big one right now is Delaware statutory trusts. I'm sure you've heard the DST, not to be referred with a deferred sales trust. So this is a Delaware statutory trust. They can sell residential rentals and then buy a beneficial interest of real property. So it's similar to a TIC, but it's a hands-off approach where they're owning a fraction of a large commercial building. This is passive income. It's very illiquid, but it allows the client to list with you, sell their property. You can give them an opportunity to find something that's diversified as an alternative investment to make money on their money. So everyone wins in that scenario. If there are questions on DSTs, let's save them to the end so we can get through the fundamentals of the pitfalls at the moment. Excuse me. Now, like-kind property, right? This can be broad. We talked about it. Okay, principal residences are not included in a 1031 exchange. That tax code is IRC, or Internal Revenue Code, section 121 or 121. That allows single filers an exemption on gain of $250K and married filers up to $500. For those of you who have been paying attention, I know that CAR, I was at the convention in Long Beach. I spoke with a couple reps and candidates out there, which was great. And they were saying that they're trying to fight to increase 121 primary for exemptions, right? So they want to have single filers have exemptions on gain, taxable gain exempt of up to 500,000, where married filers get up to $1 million in California. That would be fantastic. That would allow you as realtors the opportunity to present this tax code, right, for those who are unfamiliar, and be able to have them list and know that their take home is a lot greater and they have freedom with their money instead of just sending it off to the government, right? Now, a big one that we focus on here in Southern California, Orange County, I mean, like I said, Laguna Beach area, when I'm in even Anaheim, Brea, gosh, you name it, wherever you are for the long-term rentals, and then Coastal and Laguna, Dana Point, San Clemente, wherever you're at, there's vacation rentals, right? That's as much as we all get stressed with traffic during the summer because everyone wants to come visit us. It's so beneficial because these VRBO, I know it's Verbo now apparently on their commercials, but when they own these properties, there's a revenue procedure for it. What that means is there's a procedure within the tax code 1031 that allows them to rent their property. They hold it for 2 calendar years. Each individual year, they can rent it for a minimum of 2 weeks, then they can stay in it for 2 weeks at the time. Or if they rent it a longer time, call it 7 months, 8 months, then they can stay in it up to 10% of that time, right? So there's a lot of tools here that they can get some use out of a vacation rental and really get some family time or enjoy it themselves as well. Does anyone have questions on pitfall number 3 that we just covered? Okay, I got one. How do you handle a principal residence that was later rented out, thus investment? So great question. Typically when I have a client that says, okay, I had a primary residence, I lived in it for 2 years, and there's been a renter in it for 3 years, total of 5. That's typically acceptable to use a combination of the 2, right? Your primary residence under 121. So we're looking at the cost basis. What did they buy it for? What was the gain up until the 3-year threshold marker when someone moved in? all right? That new basis, if you will, if there's any gain, they can use a fraction of the 1031 exchange from that line in the sand on gain up to year 5. How do we figure out the exact numbers? CPA, right? So their CPA will help them file. Their CPA can know what the property was appraised at on the closing docs, right? They have all that information. They know what they bought it at. They know the loan. But there is a tool to use both, right? Which is very beneficial. So I appreciate that that question on the investment and primary property combo. Same concept applies when you're looking at maybe a duplex. Let's say the client lives in one and they're renting out the other side, right? They can go ahead and use the exemption on gain on the primary side and then go ahead and exchange on the rental side. Same concept applies for those of you, just like in my neighborhood area, that there's a lot of zoned R2, 3 properties that are, the back houses are rented, the ADUs, those are huge right now, right? So if that's full-time rented and they sell the property, you can work at the fraction per square foot and see, all right, the back house is 800 square feet. It was rented for 3 years. We lived in the front property for 3 years. We're going to get the exemption on gain in our pocket, and we can exchange the back portion into something else, right? So a lot of neat tools there. I have one more question here on the Q&A, and then I'll move on to number 4. It states, with regard to matching the mortgage from the relinquished property for the replacement property, can a renovation loan be used for the replacement property? For example, relinquished property sold for $900K, mortgage was $300, closing cost $60, net exchange proceeds $540. Replacement property is $700K, purchase and net proceeds $540, and renovation loan $300. Is this okay? So, love this question. We actually have improvement exchanges at API. So what would happen, obviously, as you mentioned, the $300K mortgage was eliminated and they want to go ahead and purchase the replacement property to renovate to get to that $900 less closing costs. So we'll call it, what is that, $840, right? That's for full tax deferral. Now for that $840 number for full tax deferral, there's a surplus of about $140K, which I'm glad you pulled this from the example. So that $140K essentially could be discussed with a lender to obtain 100 of which maybe came from the loan, 40 of which was cash or flip-flop. They can absolutely obtain a renovation loan, or what would happen in the fact if this person had no debt, right? We would hold the remaining $300K, right? And the property was $700. They would draw on the exchange proceeds from the account just like a construction loan and have 180 days to improve that replacement property, right? So finding a replacement property and deciding, well, if I take some of the money out, I'm going to pay taxes. Why don't I just buy this property and improve it? You have 6 months to do so, and they need to identify the improvements when they send in their ID form, but it is absolutely acceptable and absolutely acceptable to go ahead and get a renovation loan. A loan is a loan, right? Thank you for the question. Pitfall number 4, using a person who's considered disqualified as an intermediary. This came up, right? The question was, well, can I use someone else? And I mentioned you cannot use anyone. So it's not the taxpayer or a disqualified person. So you can't use someone that is those two, right? You can't use yourself. You can't use your realtor. You can't use someone who's disqualified, right? So our goal here is to make this seamless when the client files taxes. When we create that exchange agreement and the assignment, that's our job to show a track record. If our client is ever audited, guess what? We're holding that form, that identification form, or even the napkin that we've now printed, right, and had in their document, and we can send this off to their CPA, all their closing statements, and they can prove to the IRS that they completed a successful 1031 exchange through the use of a national qualified intermediary by the book per the tax code, okay? This is really crucial to clients, as mentioned in closing, or excuse me, attorney states that use closers as attorneys. And sometimes they do want to commingle the two relationships, and it's just to have a separate qualified intermediary at every turn. Now, what will the qualified intermediary exchange, or excuse me, intermediary prepare? as I just went through that verbally, our exchange agreement, the assignment, notice of assignment to the buyer, our account forms, our detailed closing instructions. And again, we work directly with your client and with escrow. So we can kind of fill in the gaps here. We actually send out all of our own DocuSign forms, so it makes it very seamless for the client. We don't require a wet signature at this point in time in 2022, which is fantastic. Pitfall number 5, I don't see any other questions at this time, so I'm going to move forward. Not consulting with a CPA tax advisor before closing on the sale of relinquished property. Oh my goodness, this is a big one. Please, please, please always have your client, if they ask you, well, should I exchange? You know, you can recommend an exchange, but really at the end of the day, if the client has some weird nuance of how they've held title, maybe transferred it from a parent, transferred it from a family member, maybe they've only held it for 6 months, right? The goal of the 1031 exchange is to focus on the intent to hold. If the client is held for 6 months, that's essentially a flip property. Could the tax code or the tax IRS structure push back on that? Absolutely. They could say you've only held for 6 months. The intent needs to be you're holding for a long-term investment. Their CPA can explain to them, hey, maybe you should do it within 6 months. Maybe they filed within those 6 months, claiming one of those properties was an investment. All right, this is all in the hands of the CPA. When those questions are asked, I have private letter rulings, which are court cases, to use as examples. All right, I don't ever say yes or no, you should or shouldn't. If they tell me, hey, I'm doing an exchange, we've owned the property for 6 years, it's always been an investment. Here's my purchase price, my basis, and here's my gains, my selling price. We're doing an exchange. Absolutely. We set up exchanges in that matter all the time. If they do prefer a soundboard explaining, you know, which typically they do, I'm more than happy. I'm all ears to understand, listen, and see if it does make sense. But when those nitty-gritty questions come in, we will always, again, send them to their CPA. If, let's say, the client has bought a property for 500, they're selling for 600. They have 100K in gain, but they improve the property $75,000. That means their adjusted basis is now 675 with 25 in gain, selling for 700. After closing costs, the gain's pretty much wiped away, right? So sometimes when we look at those numbers, it doesn't make sense for a client to exchange. And if someone states those specific facts I just reviewed, I won't advise them to do an exchange, but I will say again, talk to your CPA. Pitfall number 6, we're getting there. Not handling partnership LLC issues properly. Okay, so we all have our favorite title representatives and escrow companies and lenders, right, that we work with. A lender can help you pull a 1003 on non-owner occupieds, right? Same with your title representative. When you're working with them, you should definitely know, pull a prelim when you have a listing. Make sure you know who the taxpayer is. I had one come in that a gal said that she was going to do a 1031 exchange, and this LLC showed up on title that had nothing to do with her. It filed a K1, which means it was a regarded entity that filed its own tax return, and she was not even a member. It was her parents' LLC with another member in their family, thereby filing its own tax return. When we're getting into these questions, I ask these questions, right? And hey, what does it show reflective? Your RPA needs to match title, right? That's common sense. That's, I feel like, Realtor 101, which you're all very knowledgeable in, that when you have that title or deed, you know who your seller is. As an accommodator, if we get to this point and a prelim is pulled and it's some random person or a different entity than what the person I spoke with declared, we have an issue. You as a realtor have to create an addendum, right? Or an amendment, hopefully use your SIE, and this is irrelevant. We either need to change title, we need to go ahead and re-record, we need to have the proper signatory on everything to be cohesive, okay? Now, briefly on partnerships. Clients call in and say, I have a business partner. A business partner is not what we get weary about, excuse me. It's about an actual partnership on title, right? I think those two terms are loose and interchangeable. So for us, it's an actual LLC partnership on title. If let's say there's 4 partners that sign as managing members of one LLC, and only 3 of them want to do an exchange, the last guy wants to cash out. That creates a problem. Anytime in that scenario that number 4 guy wants to cash out, say he wants to take his $1 million out of a $4 million sale, that $1 million has to be distributed evenly to members unless they have another agreement. But either way, in an LLC partnership, it has to be distributed. So it's good to get ahead of these things. I can look at title with you and we can talk about solutions and how we're going to prepare this months in advance. Rather than, you know, creating all this work for you and time and money that it takes to have this listing be successful. Any questions on LLCs before I move on to 7? Okay, one last marker here. I have tenants in common as mentioned earlier. It's best case scenario for exchanging partners and investment property is owning title in a TIC, tenants in common. Those 4 members, if they were 25% owner, right, add up to 100% ownership of real property, when they go to sell, they can all go their separate ways. So it makes it a lot easier.
Here's what I found.
Oh, serious listening. Excuse me. Pitfall number 7, not evaluating the entire exchange transaction on both sides of the exchange. We talked about buying power, right? So I use that term, it's my term. I just think it's crucial for you as an exchange agent. If you start using this tax code, that's what we'll call you. You're our exchange agent. If you were analyzing both ends, imagine this scale, this checks and balances scale, right? So we need to match up for that full tax deferral. You can absolutely be in escrow with the property to be purchased or the replacement property at the same time you're in escrow with the relinquished property. So long as we have the domino effect, right? The relinquish closes first because we need the sale proceeds on behalf of the seller to wire over to the replacement. So it's good to analyze what's out there. Now, obviously, highest and best offer is the key here, which is tradition in accepting any deal. But please also note a huge takeaway as a realtor is that number of close of escrow date. We're seeing that market shift, right? If your client has a close of escrow date on the relinquished property, which we saw of a matter of 7 days, right, which was out of control over the summer, when that was occurring, right? Well, now they have to scramble and they have 45 days approaching. That only gives them 52 total days if you add in the 7 to close on the relinquish to identify replacement. So it almost benefits to counter with a longer close of escrow to give your client more time to find the replacement. On the flip side of that, you can have an EMD and open escrow submitted into the replacement property. So you open escrow on the replacement, call it a 60-day purchase close. Yes, it's a contingent offer. However, your client could be selling an all cash $5-10 million property, right? So you could be in escrow with this one first, a longer close date. And when an offer comes on this one, have a shorter close date. So that way they're securing the replacement property first. Now, there are tools for reverse exchanges I will touch on, but that's for a longer, more detailed class on reverses and intricate exchanges. I'm going to see here, looks like we may have a question. Mark. So Mark, hello. What if you hold separate properties and separate LLCs, maybe in different states, but all are disregarded? So disregarded means it's disregarded. The LLC is disregarded to you as the taxpayer for those who are not very versed on LLCs. Wholly owned by one holding company. So let's call it Kayla Firking is I'm the managing member. They're all disregarded to me. And I have LLC 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, right? 4. So this question is now, they're the same taxpayer, which would be Kayla Firking, the holdco, but different legal entities for relinquished and acquired properties. Does that work as same taxpayer? It sure does. It sure does, Mark, because at the end of the day, who's signing that tax return? I would be, right, in that example. So if it's a disregarded entity, it's disregarded in the word itself to the actual taxpayer. I have a lot of clients that have LLCs, just as this example by Mark, right, that he wrote in here, and they have 4 or 5 of them, and then they maybe have it disregarded to a corporation. Same thing, the corporation is actually doing the exchange. So we need that person to be signing off. So I really appreciate that question. Thank you. And that brings us to this slide. I was like, where is that one? Here it is. It's next. So I'm glad you asked that question. The entity that sells needs to be the entity that acquires, right? So we can't just midstream switch the taxpayer. In that example of the partnership, a solution that I usually present to our clients is if you're selling in an LLC with 4 members, it's regarded, meaning it's regarded as the taxpayer. The LLC sells, the LLC needs to buy. After holding the replacement property for a year and a day to 2 years, that's the recommended timeline for holding. They can quit claim deed into tenants in common, 25, 25, 25, 25%, totaling 100 ownership, and maybe have one person sell their fraction to the other investors. Obviously, you have to have willing investors, right? The other end of that is potentially deciding way ahead of the game, we're going to go ahead and quit claim deed title and add this new tenants in common, right, on title of 25, 25, 25, 25. And at that point, after you wait a year and a day, do an exchange that way. So again, being ahead of this, having a lot of conversations with your clients is crucial, and then bringing us in so we can ask those tough questions. Now, almost there, pitfall number 8. We are at the top of the hour here, exchanging in a related party. This is a big one. I mean, we have so many people in our area that are grandfathered in or inherit property or want to sell to dad or sell to mom or have sell to daughter, right? An investment property that maybe they were renting out to their daughter. At that point, when they do a sale transaction, dad cannot end up with cash. If dad, let's call it my father, Mike, sold me a condo, which did happen in Oceanside, right? We'll say he sold me a $600,000 condo in Oceanside, California. I purchased that property, held it as my investment. He now has to do a 1031 exchange out. None of us can end up with actual cash. So be very cautious when someone says I'm doing an exchange and selling to my daughter, my father, whatever it is, right? In that capacity, Mike, my father, didn't exchange out into DSTs. He didn't touch the money. If, for instance, I went ahead, I bought the investment property and he took cash. The issue there is the IRS could see Mike as gifting me the cash as a beneficiary. So there's a big issue, big red flag there by the IRS. They do not want anyone ending up with cash and related party transactions. We have one question on this. Relinquishing a rented single family rental and exchanging for a multi-unit property, then living in one of those units before the 2-year mark after the exchange. So these are gray area questions. I will say we can get into the weeds with what ifs. I recommend doing a legal 1031 exchange investment to investment, waiting a year and a day to 2 years, especially if they're converting one into a primary. That's a 2-year hold prior to converting to a primary. Then they can go ahead and live in one of those units, okay? If their CPA recommends something different, fantastic. How will the IRS know they're living in one of the units? You know, I don't know. Where did you fill up your gas tank if you're audited, kind of thing? So that's when I put my earmuffs on, and you know, I don't sign the client's tax return, but I recommend, again, if they're exchanging out of investment into more investment, wait 2 full years to convert into a primary, so that when they start filing, that's now under IRC section 121. Yep, thanks, Mark. Ryan, can you repeat your thoughts on what is RPT? Related parties, I assume? Okay, thanks. It's tough when I can't see you guys, so I'm sorry. Thank you for your patience. So related parties, my thoughts, right? So as far as what happens here, the takeaway is no one can end up with cash. If I'm exchanging into a property that my brother owns, he now needs to be selling it or exchanging into more property, right? What if it's his primary? If I'm exchanging and buying into his primary property, then there's different tax codes, but again, illegal, cannot end up with cash. Who's to say that my exchange sale proceeds that had gain that I deferred and I bought my brother's property is going to take that and gift it back to a family member? So Lots of issues there. Again, CPA questions, in my opinion, for the related party. Just the takeaways, that final bullet point. If you have two family members that are both, maybe one doing an exchange into an investment, the other out, fantastic, right? But anytime there's money involved, someone's touching money, that's when the red flag is in play. Here's another question on relateds. And Jeffrey, yes, my slides are available. We'll be sending them out. Elsie and I are gonna work on that after this, and we'll get them out to you, absolutely. This is also being recorded. In a related party transaction, would the relinquished property need to be appraised and sold at the appraised value? If sold for less than the appraised value, would that portion be considered a gift? Great question, CPA question. Again, I'm sorry. So I'll tell you, in my personal experience, I paid a little less than fair market value. Thanks, Dad. There wasn't an issue. I maintained that property as a rental. I think within fair market value, you're in a good spot, but I would definitely have them talk to their CPA on an individual basis. If you're talking hundreds of thousands of dollars less, that's kind of, you're adjusting property tax basis there. So a gift, maybe there's an option there that the CPA has a tool that they can align a gift, that there's another structure that I'm unaware of. Okay, last pitfall. This is a really big takeaway here. Reverse exchanges. Your client sees a property on the market that they absolutely want. They need it, they have to have it. That's fantastic for you if you're the buyer's agent, right? You go ahead, you open escrow with them. They have their own money, so they wire in an EMD within the 72 hours and they have an open escrow. Excuse me, let's say that escrow is 45 days, okay? That 45-day escrow, now they have to set up a reverse exchange. What would happen is us as the accommodator would create a brand new LLC to be assigned as the new title owner, right? So we assign that LLC into the contract so that at close, it's now on all the docs and it records with the LLC. Day of close begins a timeline of 180 calendar days in reverse, or 6 months for them to sell the relinquished property. When they sell the relinquished property, the sale proceeds can either pay off the loan they acquired to buy the replacement property, maybe replenish their savings account they pulled out of. So there's a lot of ways to use the reverse here, especially when those properties come up that are rare in neighborhoods that your clients desire. Now, a big takeaway here for the reverse, the client has to come up with the cash or cash and debt combination to outright buy that property. All we're doing here is creating a new taxpayer to hold the property. That LLC isn't Kayla Firking, right? So as Kayla Firking, I can't own replacement and relinquish at the same time. That's just me owning two properties. By the word exchange itself, there's this placeholder, which allows me 180 days to actually do the delayed exchange, which is what we've been covering today. So when this sells, the money just goes back into my own pocket, right? This one allows you a little bit more freedom, in my opinion. Now, the improvement exchange we covered, let's say I sold for $1 million, I bought for 700. There's a surplus without closing costs of about 300,000. I can draw on that 300,000 that the accommodator holds for me to improve a brand new roof, electrical, flooring, anything that's improving real estate, not appliances, not furniture. We also have a combination of the two, reverse improvement. So that's acquiring the replacement property, having excess sale proceeds from this property, giving you 180 days in the forward motion to improve the replacement property. So it's a little bit more intricate. We can discuss that on a personal note, but there are ways to use a combination of 180 on this reverse timeline and an additional 180 on an improvement timeline. So many unique tools here that I kind of geek out over that we can create for your clients. It looks like I have a few questions, which I assumed I would here. Okay, this is the appraised one. I'm going to delete that. And then there's two here. Okay. If an owner moves out of their original house to rent it for 24 months, what would you need from them in terms of documents to do an exchange with your company? So the rule of thumb there, when you look at it, it's typically rent for at least 3 out of the last 5. Okay. Live for 2. it really doesn't affect us what we're doing. Documents as far as did they do it the right way? If they tell us we're doing an exchange, I don't care if I'm audited, I'm going to go for it. We do that. We will go ahead and set up a 1031 exchange because we are covered with our own insurance. It really affects the taxpayer doing it. So I behoove them to speak with their CPA on their specifics and ask them, how long do you recommend I stay in there? It's usually you live in it for 2 years out of the last 5. Hey, thanks for the stellar webinar. I appreciate that comment. Moving on to the next slide here as we wrap up the highlights, right? Again, talk to me beforehand. If you have a client and you're a little confused on it, we can jump on a Zoom. I'm more than happy to meet for lunch, for coffee, you name it. We can jump on a call, whatever is easy with your schedule. We need to make sure that we have that contract set up and it's assignable. That assignment is prepared prior to close. That you have the cooperation clause somewhere, hopefully, either it's that SIE, seller's intent to exchange form through your zip forms, right? Or we have an amendment or addendum, depending on how you structured your contract. Now, we need to have our EA, exchange agreement, created. Let's say that the client is already versed on the ID rules, which I can cover with them. Taxpayer has to close by day 180, right? So we have to have the completed exchange from the relinquished to the replacement all within 6 months or 180 days. The QI question came up, I think, 3 times today. So your due diligence, who are you working with? I mean, in general, I think it's all about the relationships you build and your referral base and who you trust. I would love to earn that position with you. It's really good to focus on this. So whoever your QI is, ask the important questions. Where does the money go? That's a big one. Big takeaway. Again, we never commingle funds. We do segregated accounts. We have qualified trust accounts, and we have sufficient fidelity bond coverage. We have over 100 years of experience, believe it or not, from coast to coast. Our team is actually comprised of almost 100 employees now, which is big for us. So again, the security of funds is really what we pride ourselves on. Now, this last takeaway, I know some of you are logging off, so I'm trying to get through this quick, but thanks for those of you who are still sticking around with me and valuing my time. I truly appreciate it. This is a big one for you. I have another one in front of me. It's probably going to be flipped or blurred because I'm on a blurred. You can't see it. No, but there's 5 reasons to exchange. Look at this bottom part, compliments of. Plug in your photo in there, your information, type it out, put this, save this as a PDF, email it out to everyone. And guess what? We have over 180 topics that you can send out. The one I had that I love is 6 strategies for commissions that I had at when we sponsored the CAR event in Long Beach, the Reimagine. So I was there. And I was helping y'all with this really cool one. Again, it's blurred because of my background. There it is. So we want to go to work for you guys. This is great information and material for you to use. It's on our website. If you need help with it, let me know. I'm more than happy to walk you through it. There's also an amazing capital gains tax calculator available on our website. So rather than giving that legal tax advice, right, you can send your client that calculator, which is fantastic. I have more classes on YouTube. We have a great marketing team around remember, we've been around for over 31 years. Good timing, 1031, right? So we have 1031 Exchange domain on YouTube. We have our Facebook, we have LinkedIn and Twitter. This is all of our information for our national level. Here is my contact. I'm going to leave this up for a second and really open to questions and chats. Maybe someone has a specific situation they have going on, that they have a quick question. You can always call me as well. So I'd say I have to jump. Thanks for getting webinar. Thank you so much, Mark. I appreciate the questions. Again, there's no 1031 exchange that's too difficult for us. So we have the improvements, the reverses, the built to suits, the delayed, you name it. And right now we are seeing that shift, right? So we're going to be having a lot more focus on looking at investors. Investors unload and they want to move their assets. Depending on what happens with taxes that rise and who we elect, we could have more movement as well. So I'm excited about what's to come. I know people are a little nervous, but I think if we create these relationships early on, we're all going to be destined for success. So There's a question here, Elsie, maybe you can help me out. The recording, I think, yep, I think Elsie said it'll be sent out. Any chance we can watch this later? Yep, everything is recorded for your viewing pleasure. Call me directly if you need me. I'm actually going to type in my mobile here. So this is for your eyes only. So this is going to be my mobile number. If you need me, you can text me on that. You can call me on that. I'm more than happy to step up for you and your clients. So thank you guys for your time and spending your afternoon with me. Go get them. Thank you.